Good afternoon, everyone. Welcome to our Real Estate Investment Implications Across Africa webinar. This is our third webinar in our COVID-19 Impact on Africa Real Estate series. Last week, we had a very successful and insightful session focused on the future of African retail. And this week, we'll be continuing with the discussion and looking at the impact of the pandemic on real estate investment and what this means for investors, developers, financiers, and the broader African property market. For today's session, we've assembled a Pan-African panel, including representation from some of the continent's leading organizations out of Nigeria, the UK, and South Africa. I'd like to now welcome our speakers. Moderating and setting the scene for today's discussion is Tom Mundy, Head of International Capital Sub-Saharan Africa at JLL. And our panelists, Ni Adelei from Standard Bank Group, Paul Omnawibe from Landmark Group Nigeria, Ilaria Benucci from CDC Group UK, Thomas Schultz from Growthpoint Investec African Properties. Thank you all for giving of your time and helping us to answer and provide insights into how we as a sector can navigate this challenging period. I'd also like to thank our webinar series sponsors, Standard Bank and Nedbank. This afternoon, we have exceeded our previous record and have over 750 attendees from across Africa and internationally. From a housekeeping perspective, please note that we encourage questions to be asked throughout the session. These will be available on the chat function, and we'll try answer as many as we can throughout the session. We'll also be conducting polls, and we encourage active participation in these. We'll then share the data and insights from these polls once the session is concluded. We'll also make the video available to all registered delegates. I would now like to hand over to Tom as well as the panel. Tom will start off with a brief introduction, and then we'll go straight into the session. Thank you and enjoy.
Okay, thanks, Kafir. Thanks, API, for putting this together. I appreciate all the hard work you're putting into getting these webinars done. It's a difficult time, and it's very well received. So from my side, I think we've got a fantastic panel today, covering all aspects of the real estate cycle. From my role, I'm just going to give a 5-minute introduction just to set the scene, and then we'll launch into questions. If you have questions, as Kafir said, please just do raise them through the chat button. So just to start, as a bit of scene setting, JLL, we employ 92,000 people across the world. We do around $1.2 billion of capital markets transactions globally every working day. We have a lot of visibility to what is going on in the world right now, particularly in response to the questions that are arising through the COVID-19. And we also have a lot of experience of working across the African continent too. So to set the scene, what I'm going to do is just look at some of the main themes that we are seeing globally, and then bringing that into to the panelists so we can nail down, try and get a little bit more transparency on what's going on in Africa. Clearly, there's a lot of discourse around developed markets. There's far less discourse and there's a far less transparency around what's going on in African markets. So one way to do this perhaps is just to work through the key sectors, raise a couple of points, and then look at what's happening in capital markets. So clearly in the office sector, there's a lot of pressure on a sector which is already obviously at a very late stage in the cycle in developed markets. That's not the case in Africa, which is very much, at least in my opinion, at a very early stage in the cycle, and is behaving in quite a different way, has been behaving in quite a different way to developed markets. But we are seeing, and certainly we are seeing in Europe, the US, and we have seen in Asia, a significant delay in investment activity. We are seeing softer rental growth assumptions than were previously forecast. There are obvious questions, structural questions around remote working and the impact on office utilization rates. Will we see over the longer term fast tracking of the adoption of remote working and more investment into collaborative technologies? In the retail space, global retailers clearly have been navigating a period, for a while, navigating a period highly elevated risks to cash flows, and an increase in operational risks and costs, all coming from what is a very evident slump in consumer demand and disruption to supply chains. And a key narrative for retailers right now is protecting income streams, particularly for those operators who run on relatively thin profit margins. That being said, we are seeing a near universal rolling out of temporary rent relief from landlords. We are seeing it in South Africa as well. There are costs that are being borne. But at the same time, defensive retail assets remain highly sought after, as does prime retail space that is deemed of strategic importance, both for operations and for brand awareness. On the industrial side, it's all about the disruption to global supply chains. Reduced activity at major gateway ports and airports has seen a significant fall in utilization rates and significant increase in idle resources. We have seen already an acceleration in the use of automation and a significant reduction in the sector's reliance on labor. And the other obvious narrative that dominates the relationship between retail and industrial is the increase in online shopping, particularly for groceries. Is this going to become more permanent? And will this in turn boost demand for logistics space? Markets, we've seen this particularly in some of the South European markets which have traditionally been slow on the uptake for online, are now increasingly forced to adopt that dynamic for online shopping. Is that something we're going to see in the African space? Is the logistic capacity there to absorb it and support it? In the hotel sector, clearly the impact of travel restrictions, cancellation of events, reticence to travel, as well as outright bans on travel, have been felt very severely, with a significant drop in the short term in occupancy rates across the sector. But arguably, we could say that once we do get through this, there is the potential for a more rapid recovery than in other sectors. And finally, what is the impact, therefore, on capital markets? Well, it's certainly the case that investment activity has started to slow as investors react to this uncertainty. Arguably, retail and hospitality have been the most impacted in the short term. And broadly speaking, there is a shift to defensive assets and a focus on quality and a focus on core. At the same time, and just 3 final points to round up on, there is significant opportunistic capital sitting on the sidelines. There has been towards the late stage of this cycle. The press is full of news at the moment about funds that successfully raised. Blackstone just raised another $11 billion last week, now sitting on $30 billion of opportunistic capital on the sidelines. PAG yesterday raised almost $3 billion for an opportunistic Asian fund. I'd like to see some of that capital coming into Africa to take advantage of some of the opportunities here. Also, real estate, as a second point, we've seen this through previous cycles. The overarching trend has been, when interest rates are low, that there is an increase in allocation for real estate as a sector. It is our strong view, and I think it will remain through this period of volatility, that real estate offers relatively attractive returns relative to other asset classes. And finally, and it's a very specific point on Africa, is that we have had considerable experience in dealing with volatility. We don't just talk about the 2008 global financial crisis, we talk about the 2014 oil price crash as well. And almost everyone who's had any experience in these markets has gone through these cycles and has worked out strategies to mitigate those sorts of risks. We are vulnerable to external events, but we are also resilient, and as I said before, extremely experienced. And talking of resilience and experience, it's a good opportunity to go into the first set of questions for the panel. Now, I'm conscious on the panel, there's a couple of things I think before we start to make very clear. I'm conscious that on this panel, we are dealing with landlords, with owners, with funds, with investors, with developers, with debt. So we have a whole range, really, of the capital markets cycle structure that we can talk around. I'm going to start with my first question for Tom Schultz at Growthpoint Investec, which I'm going to refer to consistently as GAP, if Tom doesn't mind. GAP closed, what was one of the most significant real estate transactions on the African continent last year. I suppose the obvious question when you've got a portfolio of such depth in markets like Ghana and Nigeria, Zambia, where you've got retail and office exposure, without pressing too much detail on how you are handling the relationship with your tenants, I'd be interested to know how you're looking at your current holding and what sort of current holdings and what sort of discussions you're having right now.
Yeah, thanks, Tom. For us, that's probably the most important question that we're facing right now in our portfolio. As you mentioned, we're quite fortunate that we've got a very strong, and you mentioned earlier in your intro, the importance of core and dominant assets in a portfolio. We've got a lot of very, very good assets, A-grade tenants, really an amazing portfolio. And fortunately, on the office side at this stage, we're not yet seeing too much strain. Clearly, we are a little bit behind the curve from a timing perspective, at least with regard to the developed markets that you were referring to previously. So we certainly do expect in the medium and longer term some pressure on the office side as well. At the moment, we in fact still have a few tenants that are looking for space and actively negotiating with us. Our retail centres are obviously more vulnerable in the current context, but there as well, it depends on which markets you're looking at. Zambia, as you might know, still largely open. Trading is obviously down quite a bit. People are cautious. We've also found our smaller centres are trading better, the sort of strip mall type configurations that have got large anchors and less food and retail, etc. They are a little bit more shielded from this. But clearly, quite early on, we did quite a bit of work long before we locked down and long before we got to a point where we were dealing with these restrictions, that we categorized tenants, and you would have seen some of the stuff come through in the South African market, potentially categorize the tenants in terms of their vulnerability, and so adapted that to our environments, and looked specifically at some tenants that we knew were vulnerable even previously based on their trading figures and their turnovers. And clearly, their restaurants, movies, entertainment centres, and so forth are very vulnerable. And what we try to do is we try to engage with our tenants long before our tenants come to us, to let them know what sort of discounts they could be looking at, what sort of rental relief there was going to be, and depending on category, depending on tenant, to let them know in advance what they might be facing and whether that's partial restrictions or full lockdowns, and just engage with them on an ongoing basis for them to understand what their costs are, they can manage their costs, and what we're doing on the cost side, also what we're doing on the health and safety side with regard to physical distancing in our retail centres and hand sanitizing and all those sorts of things. And really just trying to create an environment where we can trade through this situation with our tenants, because the last thing we want is for tenants to fall over in the medium to long term, and a year from now we have fewer tenants than we had previously. So it's a very collaborative process, and I think it's been well received. We've had a few individual requests come through from tenants, but I think our sort of proactive approach did allay quite a lot of fears, at least for the moment.
Thanks, and I'll throw that question to Ilaria, because I think it's also relevant for you across also other sectors. You know, you've got quite a broad sweep of the brush.
Yes, thank you, Tom. We do have an hospitality portfolio which is suffering, as you might guess. We have about 20 assets, out of which 10 are now closed, or the one open are open at request of governments, so to help basically the situation. We have some stranded people in South Africa. We have the army is taking the hotel in Abidjan, and so on and so forth. Therefore, the situation is very fluid. I think that what is important for us, specifically across the whole portfolio, but obviously is liquidity and balance sheet, because I think that the one thing you can control is liquidity today, certainly not cash flow, or at least there's a lot of uncertainty. I think another key point which I like to, I think that Thomas also mentioned is safety of the people working in our facilities, in our assets, because again, some of these hotels are open, so how you try to secure safety for our employees. I think that the other thing depends. Asset classes are behaving very differently here. as we know. I mean, I know that there will be probably will go more into specific, but beside, again, obviously the hospitality portfolio is suffering a lot. On the other hand, we have a logistic exposure, and the logistic exposure so far, fingers crossed, seems to be doing fine. Obviously, it depends on tenants, but some of the tenants are linked to the e-commerce, and obviously there's a better reaction to the current crisis. I think that, again, we are trying to assist them. The point is, at what stage would you need additional financing? I mean, would you be able to support the companies to bridge towards the end of this period? I think it would be a question of timing. We are prepared to support them, but we need to understand very well what's the business model, what's the plan, what is the, if you like, exit strategy. As do we need to look at conversion? Do we need to look at the short-term trends and long-term fundamentals that are changing the demand for real estate? So I think that we are still observing quite a lot, being supportive, and trying to talk a lot, actually, key point, talking a lot to banks, because obviously that is another key point to get through this through this crisis. Obviously, we've been asking waiver of covenants, extension of interest payments and principal, and so on and so forth, as I did personally in 2008 and 2009. So that is a bit of the deja vu, but this is what we're doing right now.
Thanks, Hilaria. And I want to grill Nee, representing banks, but before I do, Paul, I think there's a question here around sort of timing and how you know, as a developer and as, you know, we're working on a relatively large mixed-use project on the waterfront in Lagos. How do you view this when you look to take product to the market, when you look at these differentiations between sectors and how sectors are responding? Is your strategy at the moment changing, or how are you looking at it?
Thank you very much, Tom. So yes, so we're at a time where none of us have ever witnessed before. So a lot of this is guesswork and strategizing to see how we go forward. So we fortunately and unfortunately belong to a multi-sector environment. So retail, residential, commercial, and hospitality. So that's the fortunate part of it. The unfortunate part of it, obviously, is sector and is regional challenges in that we're literally more or less in one place. So we put all our eggs in one basket, but we hope to watch that basket carefully. So I've tried to categorize where we are and what the challenges we may face over sort of three distinct phases: the short term, the medium term, and the long term. And in the short term, so around now, during the crunch time of the epidemic, and in Nigeria, it's still, people are still trying to find out where we're going and where we're coming from. Not everybody is as conscious of what may happen and how long it may happen for. But in the short term, there's supply chain difficulties. Obviously, we're under a lockdown at this point in time. There are human resource difficulties. Real estate is not really trading that much anyway. So apart from the residential part of it, offices are closed, the shops are closed, the leisure industry is closed. So our cinemas, our beach, they're basically all closed. Our hotel is closed. So literally, we're literally just in the office market, and the office staff are not coming to work anyway. So we're keeping the offices open because they have service and things like that in them. So the short term is, how do we stay alive and keep everything going, and how do we tidy over and constrain our resources during this period? In the medium term, which is when sort of the markets are meant to open up again. So I expect another sort of, it could be anything from 6 to 18 months of real pressure and real tough times. And what we're gearing up to is how do we sort of protect our cash flow during that period? I see one of the major risks is debt. Is when our own clients come back, they won't have the capacity to pay. So we need to work out and figure out how we can work with them. And then our debt to our external funders, obviously, those are discussions we're trying to have now and in the future, in how to sort of, we have the currency risks here. We also have, the debt running, even though there's no income during this point in time. In the more longer term, and I think, like all things, when this whole thing goes away, and it surely will, and life will return back to sort of a new normal, what are the changes that we will see? So you can see in certain industries, and I know you're going to touch on this later, so I won't say too much about it, but in certain industries, obviously they're protected. when I look at the real estate industry, and I look at the sectors within the real estate industry, especially in Lagos, Nigeria, I think the office market will need to reinvent itself. I think the demand side of the office market was already under pressure even before this. I think when people have worked at home for anything between 1 and 3 months, and they come back and they see multi-million-dollar bills on their doorstep, they're going to think, well, do I really need to pay these things, and do I really need all this office space? So I think people's working habits will change, and I think office providers need to be alive to that. So it's something we are going to be alive to. We've already started looking at different sort of introducing different flexible working arrangements, introducing technology, and introducing ways almost like an office share scheme. And that's a step away from the traditional serviced office, but will help some of our office tenants and new office tenants come in at a lower cost base and make it work more for them. From a retail aspect, so we have several retail shops, I think 41 within our complex. So we're trying to do some of the centralized things that make things work for them. So, including warehouse and depot, dispatching and technology. So people, apart from people coming out to shop, all our retailers will take advantage of this central logistics part and warehousing and dispatch to do home deliveries and distant deliveries. And hopefully that will make life a lot easier for them and make our retail spots a little bit more attractive. From a leisure environment, I think there'll be a small boom when this whole thing is over, in that people want to sort of get out again and sort of, just sort of relax outside from home. So I think you'll find things like the beaches and some of the theaters and some of the sort of family entertainment centers a little bit busier than they would normally be for a short period of time. But how do we make sure that while people do that, they feel safe? So in terms of the health and safety and the PPE, just making sure that's fine, introducing some form of social distancing, because I don't think that would change a lot. And if people are playing games in arcade rooms, you want to be safe as to when you go onto it, who was on it before. So we're trying to create more sort of family-centric leisure activities as well, and more in the open air. So there's a whole series of things we're trying to do across our sectors to make us slightly more immune to the bigger impact, but at least level. I'll use a term that's used a lot during this health crisis, and that's flatten the curve. So it's more or less flattening our sort of financial cash flow curve, so we can spread our risk, introduce our income over a longer period of time, reduce our costs over a longer period of time as well.
Thank you, Paul. You used a phrase, we're asking ourselves the questions, how do we stay alive? So you're obviously one of the major debt providers in the region. What are you seeing from landlords? It's a difficult time for landlords. It's a difficult time for real estate owners. You have exposure across the continent. Without necessarily picking on individual countries or talking about Nigeria specifically, but broadly, what are you seeing? How are you responding to these questions? And what kind of leeway, perhaps, are you giving, and how understanding are you being of landlords who are being put in difficult positions through no fault of their own?
Thanks, Tom, and thanks to everybody else on the panel. I was expecting the difficult questions. I think when you look across the markets that we operate in, the trend is consistent. The most vulnerable parts or the most vulnerable sectors, as highlighted already, is the retail and the hospitality sort of assets. Tom Schultz already sort of mentioned that, but the impact sort of varies from market to market. We've seen, I mean, when you sort of look at it, you can probably take a range of trading that probably ranges from anywhere from about 35–40% of the retail center trading to about 70%, depending on the market. So our approach has been sort of looking at each client on a case-by-case basis, because the realities will be different. The narrative, I mean, the reality is that this is not any sort of self-inflicted type scenario. This is a global pandemic that nobody could have. I mean, we could have, I guess different countries could have sort of responded differently, but the impact of it, nobody could have adjusted or prevented. So our narrative or our sort of imperative is to support our key clients through this process. But that level of the support is then sort of based on the realities of each of the clients. I mean, obviously the clients that are, we've always sort of encouraged clients to have resilience buffers. So, you know, you have a range of clients, you have those that will want to maximize debt at any cost, and to the upper limits. In this sort of scenarios, the latitude to sort of maneuver, the flexibility is heavily constrained. For the clients that have more capital and sort of have sort of sound, or should I say more robust resilience buffers, then it becomes easier to sort of find workouts or sort of flexibility scenarios to implement for them. The reality is that we all don't know what the full impact of COVID. If COVID is 3 months, obviously it's a lot more digestible. If it moves, if the impact of it moves to sort of 6 months, 9 months, 12 months, then, you know, the impact of it on all asset classes will obviously be very much more challenged. So you've got to sort of look at it in bite sizes. I mean, from a lender perspective, you also want to ensure that, I mean, for clients that are multi-banked, that there's an alignment between the solutions that one lender provides to the client across board. Obviously, talking about asset classes, the corporate residential spaces, the office sort of segment, industrial segment appears at the moment more resilient. I mean, there've been sort of multiple schools of thought about whether the way we work will differ. I mean, incidentally, they talk about habits being formed in 3 weeks. So we've been all locked down for about maybe 3 weeks to a month, depending on which country. So maybe habits are formed, but there's a different school of thought that kind of infers that the reason why sort of remote working appears successful is because everybody's locked up. The moment there's freedom and flexibility to move, the effectiveness of that remote working may be challenged. And there's no replacement for the social interactions, which is what the leisure services are built on, which is what sort of retail is built on, which is what I mean, they provide a service, but they fulfill sort of a fundamental need. Will that need go away? That's something else that can be argued. I think the fundamental then goes to, and we've seen it in many of the markets. I think the last data that I saw in the US, for example, on employment sort of benefits or unemployment claims were aiming towards the sort of 20 million people, for example. So you're seeing in many of the markets where people that sort of their livelihoods are dependent on their daily sort of trade and their daily activities, which is likely sort of related to the retail and leisure parts of our lifestyle. That's where the pressure comes. Will the extended lockdown or impact of COVID impact that on a permanent basis, or should, you know, wipe out people's liquidity? That those questions remain unanswered, but, you know, again, it just justifies why you have to just look at each situation and each circumstance on a case-by-case basis.
Thanks, Nii. And there's a couple of questions coming through on the chat, which I think are very relevant when we're talking about asset classes and how we look at asset classes being defensive or not defensive. And particularly interesting is a question about the residential sector. Do we view that as being defensive? Why is there not more capital going into that? So I think one of the questions I perhaps might put in it, it's really for everyone, but when you look across the sectors, when you look at where we are now compared to, say, the pressures that we felt in 2014-16, more so necessarily than 2008, 2009, do you think, maybe I'll put this to Tom actually first, because, you know, you do have very specific focus, do you feel that the lessons that you've learned through 2014, 2016 have influenced your business strategy now? Like, if you look at your portfolio, if you look at your structure, your holdings across your asset classes, your liquidity, your balance sheet, do you feel that you're naturally mitigating yourself against these kind of cycles?
Yeah, thanks, Tom. I think we have learned a few things. I think particularly in Nigeria, we learned a whole bunch of things over that period with regard to liquidity and currency risk and what a dual external event, or the one in Nigeria, I guess, was somewhat internal from a banking perspective, but what a dual dislocation for Nigeria, being the oil price in this case and COVID-19 at the same time, what that can do. And I think there's a fair amount that we've learned from it, and just across all our portfolios with regard to sustainable debt levels and to Nee's earlier point, I think your ability to mitigate risk and to navigate a crisis like this is unfortunately largely determined by the shape that you were in when you went into the crisis. It's very difficult to pivot when the markets are seizing up and there are very few buyers and very few sellers, and maybe only a few opportunistic buyers who are looking to get bottom dollar on these things. It's very difficult to change your strategy in the middle of a crisis like this. So I think we have learned a lot from it. I think we are just generally, I think, a lot more conservative and a lot more focused on optimizing portfolios, and this is something on our side as a reasonably sizable and listed REIT, if you will. We were focused very early on making sure the debt levels weren't too high, and I hope Nee regards us as one of his clients that have a bit of a buffer. But we focused on bringing our debt levels down. We looked at the various assets, cross-collateralization, trying to hedge out interest rate risk, currency risk, all those things. And these are things that we do now as a matter of course. I think previously they were, when Africa was rising across the board, I think we paid less attention to it. But now these are almost sort of basic housekeeping things that you do. So yes, I do think we learned quite a bit from that period.
Thanks, and I think that's also a question as we look to the group, to the panel. I mean, it's a question about what is realistic in this market, and I think it seems to be the case over the last couple of years as the market has adjusted that we've got a much more realistic assumption about where rental levels are or should be. I think certainly is the case with you, Tom. I think, Ilaria, you'll have the same point. What about pricing in general? Do you think we've gone into the cycle with yields at an unrealistic, and I talk about a sort of first year net initial yield, or do you think there could be an adjustment now into pricing that is a lot more realistic, that would allow this opportunistic capital that sits on the sidelines perhaps take advantage of what are actually there's good quality product in the market? Could this be the opportunity to come in and seize some perhaps new opportunistic acquisitions? Ilaria, what do you have a view on that? Oh, I think we've lost the sound for Ilaria.
I had my microphone off. Apologies. Sorry. Few consideration on that. I think that valuations are impossible right now. How do you value an office where the workers and the tenants cannot go? So I would see more, if you like, different kind of products. I mean, mezzanine or something like that, because I mean, pure equity at the moment is very, very difficult. I do expect an adjustment, as in yields going down. Having said that, our markets are by and large quite illiquid besides South Africa, which means that it's always very difficult to really get some sort of relevant comparables. So a lot of the assumption, a lot of the valuation are based on your own projection or the projection, the cash flow, rather than comparable. So again, would this create opportunities? It would, but I think that this is first and foremost a human tragedy. So to talk about jumping on opportunistic right now, I don't think is appropriate, frankly. I think that there will be changes, radical changes, changes that are here to stay. So also that would have an implication on valuation. For example, I was mentioning earlier, this is pretty obvious, but and Paul said the same. If you look at logistics, probably logistics could actually yields go down because of the new world, the new normal. What will happen on office? I mean, also this one, looking at two different perspectives. From the one hand, you say there would not be more demand because people would reduce as much as possible the usage of offices, because now we are learning how to work remote. On the other hand, if you think about what would be the new security safety measure, so let's assume, let's be radical, that the open space will not exist anymore. So in that case, you have additional demand for offices. So I think that, again, early stage, there will be some changes. At the moment, I don't think that it's realistic to think of valuation, or even too early to consider to invest opportunistically or non-opportunistically. So I think that I reserve my view at this stage.
Okay, maybe, I mean, if we're talking about capital sources, I mean, that is a relevant question, because I mean, most of the activity we see in outside of Africa is either fundraising, there are deals closing, there is a movement in the way that capital is being sourced, particularly in developing markets. I guess there's a question for Paul. When you look at your strategy, and when you talk to your investors and your backers, do you get a sense that, you know, when you looked at when you were putting products into the market over the last, through this cycle, that this was a market that was fundamentally, and I'm talking particularly here about Nigeria, but I think it does speak to the broader West African case, that it's a market which is fundamentally oversupplied or undersupplied, and to an extent which it is possibly undersupplied for quality product, that is a mitigating factor. Is that a discussion that you raise, or do you feel that the market is balanced or out of balance as we go into this downturn?
Really good question. And as you can imagine, I'm literally on the other side of what Ilera said. So I fully agree with her. And we're on the receiving end of it. So in discussions we have with either existing investors or potential investors, we position ourselves not necessarily as a premium product, but as a sort of more best-in-class product. So I suppose the supply-demand dynamics in a place like Nigeria, and more specifically in a place like Lagos, where we are, changes radically over the last 3 to 4 years. It has changed radically. It's gone up and it's gone down. It goes more down than it goes up. Demand has been reduced just because of the economic climate, and a lot of the effective demand is from incoming or foreign investment. And as that reduces, either due to currency fluctuations or due to economic policy, then it hurts that end. From the supply end, during the boom years, people built a lot, and if you know a place like Nigeria, lots of the developers are DIY developers, they're not institutional developers. So people like us, we compete with people who virtually have money in their hands and just do the things that we do, but maybe to a less than best-in-class practice. So coming more directly to your question, yes, we basically push the angle of A, the best-in-class, B, best-in-class international practices. I think, as Ilaria said, I think when the market opens up again, I think people will be more cautious of going into offices or retail units that have been designed and are operated to better standards than one would normally have accessed. So in our conversations, we talk about impact. So we see ourselves as an organization that will be a good recipient of impact funds, in that, you know, we create employment, we provide a platform for hospitality, for reverse tourism. We have over 3,000 people working here, and in a place like Nigeria, each of those people probably employ 3 or 4 other people. So just from a community perspective, you know, we have to do our road, we have to do the street lights, we have to take care of the community. Even in a period like this, we're building a COVID center as well, because as you can imagine, Nigeria is very undersupplied with a response to this COVID thing. So we've decided to partner with YPO and the state government to build 120-bed specialist COVID unit. So there are many things from an impact point of view. And I think just going forward, I suppose the generosity and the humanitarian effort by a lot of people in the world, a lot of organizations, and in many cases some governments, has shown that the world can be strong when it's challenged in unity. And I don't think we're going to lose that, certainly not over the next sort of 3 to 6 months. And one would hope that the dividing lines between business and charity melt a little bit, and we start looking at impact investing in a much more serious way than simply just sort of financial investing. And
that's a very interesting point on impact investing, and I think obviously for CDC, that's, you know, you're thinking about these things. I mean, in any investment or any decision you make. Do you agree with Paul there? Is that something that you're thinking about on the sidelines as you look to the way Africa is going to reposition after this?
Well, I think that there will be a lot to do for people like ourselves. As you know, it's part of our mandate. We have a dual mandate because obviously we need to get a commercial return, but also being impactful. Now, I think that there will be a lot to be rebuilt. I think that one of the sector focus that we have, which is housing, is not going to go anywhere. Actually, it's going to be even more relevant after what's happening right now. And therefore, I think that we will definitely double, if not triple, the efforts to find proper investments to certain standards and that meet our criteria, definitely.
Nee, I just want to take a step back onto a point that Paul raised around the issue of currency. Well, it was many points, but the question of currency risk has come up. It's something that's gone through in the previous cycle. And I just wonder how you're looking at that as a lender, given that there's going to be pressure on currencies, there's going to be inflation pushing through, pressure on consumer spend, and for dollar peg leases, you know, across all the countries pretty much that we operate in. How are you positioning yourself to accept, if you are able to accept, I know you have done in the past, but local currency versus FX, how do you see those risks playing out, and how are you positioned?
Thanks for that, Tom. I think when there was the first sort of currency crisis across many of the markets, one of the things we had done as Standard Bank was we explored sort of dual currency sort of lending practices across the different asset classes. And those solutions are still sort of available for us to deploy, and in different markets. The realities in different markets vary. The challenge that has always sort of been there with local currency as it relates to real estate is the fact that the currency interest rates are high and in many cases volatile. The combination of both features make it very difficult to sustainably sort of apply to the real estate product. So the solution around it has always been the same: conservative debt levels. And I think, and we sort of alluded to it earlier, and many of the operators that have had the experience have sort of formulated that view and applied that view as almost as a stock standard approach. I think the volatilities that we've seen in the continent make it difficult to have highly leveraged assets or portfolios within the continent. The other element, the other approach we've taken to it is creation of portfolios, so that it's not likely, the volatility would vary from country to country. The idea is that if you have a reasonably sort of well diversified portfolio of assets to one counterpart, they may create some sort of resilience buffers for themselves across the market. Whilst and when we talk about sort of leverage levels, then you're then talking about clients that ideally should have a sort of continuous ability to access capital one way or the other. And we've seen that. I mean, the topic of conversation last 2 years was the evolution of the different sort of investing platforms in the Africa real estate space, evolving from sort of the traditional private equity model to sort of permanent capital structure vehicles, where they are not under pressure to force an exit. And I think some of that historical narrative has been responsible for what has happened to the business, or what has happened to the markets in terms of what sustainable rental rates are, what sustainable leverage rates are. Because when your paradigm is that sort of private equity sort of paradigm, your measure is IRR. That measure is a function of the higher sort of cash flow returns and the shorter time frame and the increased leverage, and that has driven the market. So we've seen the market evolve, moving away from that sort of platform, or those platforms, to sort of more, for lack of a better word, more sustainable platforms, or platforms that are built to absorb the shocks that would occur within the African continent. So looking for counterparties that understand and recognize that those realities become an easy way to organize ourselves to adjust to some of the volatilities that you will see. In Zambia, there will be volatility coming from copper prices. In Nigeria, it will be oil prices. Everywhere else in the world, there will be some commodity or the other that sort of influence how the markets behave. But what you also would have seen is that it's not likely that all markets will undergo the same level of volatility at the same time. And you've got to then sort of work within that sort of framework.
Thanks, Dee. And there was a question that just came up, and it's a slightly technical question that came up on the chat, but I think it actually leads into a broader question, which you touched on, but I think perhaps it's an opportunity to nail it down, since it is extremely topical. And the question was, I'll put it to Tom, but the question was, are you in breach of contract if you fail to pay your rent? And how do you manage that? You kind of have answered that earlier, but it slightly leads into a question about, where you've got challenges for tenants. Do you see a potential shift into shorter leases, more flexible leases? The assets in particular that you guys, that at GIAP manage, are of high quality, and there is, they would suit perhaps these kind of flexible space provision. Do you see yourself moving in that direction to manage this kind of cyclicality and questions that might arise about short-term unaffordability of rents for more challenged tenants?
Yeah, technically you are in breach of contract, but I think to Ilaria's point earlier, I think we're beyond the stage of looking at breach of contract. I think we collectively here in survival mode, and as Nee was saying, we need to work together. From our perspective, our first step that we took in all of this is to speak to other large landlords and to try and form a common position on how we're gonna treat this, just to get to a point where we allow particularly the struggling tenants, particularly some of the retail tenants that we spoke about earlier, to survive. So this isn't something that we're looking at this point in time. I mean, you really want to get through this period. You want to make sure that people that are genuinely affected, and we've modeled it very into a great deal of detail. We monitor it on a daily basis, be that footfall, turnovers, etc. So we keep a very close eye on it, and we're not deaf to anybody in our retail portfolio that is genuinely struggling. What maybe becomes a little bit more difficult is if you have blanket statements by large retailers with big balance sheets that decide they're not going to pay rent. That kind of then doesn't, that is not particularly constructive. But no, I think we're not really looking at the legalities at this stage. If you're hoping to chase your retail tenants through the courts in 6 months to 12 months from now, I think you're mistaken. That's the wrong approach in my mind.
Do you expect to see a shift into for a period of time into local currency denominated rents across your retail and office portfolio?
Look, I think it comes up, and it comes up every time when the currencies are under pressure. I mean, it's probably the biggest weakness for private equity funds or for income funds such as ours. But unfortunately, and I agree with everything that Nee said previously, unfortunately, the local capital markets aren't deep enough to access. The interest rates are extremely high. They're not as efficient. So, we have got no problem with local currency rentals or income in general. but then the debt has to be matched. And as long as that's not the case, I'm afraid it's not something that we can do. And I think what tends to happen is then when you have these periods of strain where there's huge pressure on the currency, it becomes an affordability issue. And again, to Nee's point, what you need to do, even in a normal market, is you need to make sure that you've got a margin of safety, that you can absorb some of that. And to your point, Tom, earlier around valuations and yields, and we've had a lot of conversations with valuers and with brokers about this over the last 3 to 4 years, as you know, and we felt that consistently the values were too high, and we were not prepared to pay those values. And the reason for that is exactly these sort of dislocations that you come across, where for a period of 2 or 3 years, the affordability, whether it's office or retail, goes through the roof. And when the rentals expire and renewals are up, then they revert to market, and that's what you need to factor into your valuations. So if you're paying top dollar at the top of the market, then I'm afraid that you're gonna see your returns hurt on that basis.
Yeah, I mean, I think one of the things, and we all talk about this a lot, is the African continent's obsession with the discount rate and how meaningful it actually is. I mean, it's something perhaps it's inherited from the South African model, and I guess it's a question. I'd be quite interested to ask Nee this question. Actually, is when we look at discount rates as a prism to the way we evaluate risk in these markets. Do you think when we look at things like risk-free rates, when we look at liquidity risk, when we look at the premiums that are attached or not attached necessarily to liquidity in these markets, do you think, have we been doing it in the right way? Have we been realistic enough? And do you think it's going to change? Like, do you think we're going to actually start looking at a risk-free rate that is realistic for the markets in which we operate in? And I'd say this in particular reference to Tom, because I know Tom has an extremely robust process of looking at discount rates. Do you think that's an area where perhaps we should be applying more scrutiny? We should be more realistic about the actual risks of investing in these markets?
That's an interesting question. I think definitely there are lots of practices from an African real estate investment sort of context that requires more sort of intricate sort of standardization of practices. I mean, clearly the depth of our market is still sort of nascent at best. When you look at sort of volumes of transactions that happen that can set benchmarks for you, and you need that to happen on a fairly regular basis for you to sort of find data points that become relevant to creating some sort of a curve, and we don't have that history. I mean, the closest market that provides a reference is the South African market. I mean, that sort of the rest of the African continent can leverage on its South African market. But even in that market as well, the level of trades, the volume of trades is not massive, and therefore the data points to kind of support what is realistic about whether risk-free rates, about yield curves, and those sort of matrices is still kind of it's still difficult to predict. What I do look at though is what's the real cost of actually setting up or creating an asset. And in many of those markets, some of those costs are real. There are efficiencies that you can derive there. So I think what is left to sort of monitor is what is sustainable rental. I think it's come through many conversations historically, but I think the one thing that makes a difference, and you alluded to it earlier with pressures on rentals in more developed markets, even for office space, as an example, is that in many of the markets, the fundamental sort of demand is still relatively relative to should I say supply relative to demand, it still seems quite fundamentally under the levels that ideally should be. Should it be much higher? No, there's still there's the pacing of supply with addressable demand, and that's what comes through in many of the sort of volatility cycles we go through. The assets that have sort of established themselves, even through the cycles, they tend to do relatively, they tend to be relatively stable. And as you sort of match the demand pattern and the supply to the addressable markets, I think we'll create more sustainable asset classes or products for the market, and that will then give us sort of data points to determine what is sort of our risk-free rate, our yield curves, what makes sense, what's sustainable sort of rental rates across different markets. I think we've got to build it up from ground up. I don't think you can sort of superimpose any sort of model and have a correct answer. I mean, that's my thinking at this point.
And there's a question I think that comes up, and it came up in the chat here, and I think it's quite a pertinent one, is that when we look at these issues of volatility and cyclicality, and we look for product that's defensive, do you think there's I think it's something that's already slightly started to happen already, that the product that is going to come into the market in the future is going to be much more, I say, realistic. It's going to be far less over-spec'd. It's going to be built at the right price point, probably more of a middle tier, like good quality B-grade offices rather than overly spec'd super prime. I say that with some caveats because there are a few very good prime offices in the regions in which we operate, but there's also a lot of stuff that comes on at the wrong time and is over-spec'd. So I guess the question for Paul, and since you are putting products into the market, do you think there is a chance that will happen, that we will bring product to the market that is, less over-spec'd, more realistic, better price point, more responsive to these kind of issues around cyclicality and volatility?
It's a really tough question because it means you're calling the market before it comes. But I do understand it's a very delicate balance in trying to assume what the demand will be and then providing it, or waiting for the demand to come in and tailoring it. But just the nature of real estate is there's a whole assumption that you've got to do beforehand. And I think the strength of whatever you do relies on a number of things. So when I think of it from real estate terms, I think, well, what's the quality of client I'm targeting in the first instance? What sort of longevity of tenancy am I looking for? Am I looking for short-term, medium-term, long-term? And what sort of floor plate sizes or space sizes do I want to sell? What sort of currency am I prepared to accept? And then what sort of rates will work? And I sort of work backwards from that. In simple terms, we don't try to develop sort of typical sort of grade A opulent stuff. We try to develop, and because we're in a place like Nigeria or Lagos in Nigeria, we try to model our developments on international standards. Now, that comes with both a problem, an opportunity, and a threat. I mean, the opportunity is that you're ready to receive international clients that want the international HSE standards, fire and safety standards, the floor spaces that work, and just the efficiency ratios that work. And that's an opportunity. The other side of that is there's a cost to that, because when you're in a market where the supply chain is very difficult, it's largely supplied from abroad, then you have very high cost benchmarks in the first instance once you try to meet that. They don't make things like macerators in Nigeria. A lot of fire alarm systems, a lot of safety systems are not actually made here, they're imported. And that brings into kind of a number of things. The other thing touches, it's not the question you asked, but it's a question I will ask by giving you some context first. Is one of the major issues we have as a developer is basically matching. So one of the major issues is supply chain, obviously, is how do you construct what you want to construct in a place like Nigeria at a price that people can afford? The second thing is, how do you actually finance it? And in what currency do you finance it? And what risks are you prepared to take? And the finance is prepared to take. And the third thing is, you hope that the clients actually do come. And if they don't come, what do you basically do? How do you sort of change your sectors to adapt? So let me focus on the middle bits, because the first and the last is the developer's dream. That's basically what you're paid for. The middle bit is the financer bit of it. And, and because I'm not a financer, maybe I'll ask what may seem to be a daft question. Right? So people like us, because of the nature of the finance and the bulk of it, we go to international investment companies, and we say, look, this is what we want to try to do. Can you finance us? Obviously, when we get a yes, the numbers are based in dollars, because the people who finance them are foreign, are either dollar-based, euro-based, or pound-based, as the case may be, but it's foreign finance-based. And then when you come to Nigeria, and there are a lot of organizations, whether they're pension funds or high net worth individuals, whose money is Naira-based, but they convert that money into dollars and invest it abroad. And some of this money finds its way back to finance local businesses, right? With those attendant risks. And I just wondered, why don't the international finance organizations create an office, if you like, and tap the GP finance supply from the local market so it comes in the local currency? So we take away that currency risk completely. And then when developers have to deal with numbers, you're only dealing with the supply-demand dynamics and the supply chain dynamics. But you know what has become the bigger thing in this whole thing is the finances. So we have a fair amount of dollar-based finance. And when I speak to international finance, I say, look, okay, we need some repayment holidays. We need to sort of convert some of this money into local currency. I mean, they're very unsympathetic for the simple reason is that they can't really afford to be too sympathetic. And then we come onto the impacts part of it and say, well, from an impact basis, you need to be sympathetic just to make sure a business like this thrives and continues to meet both its commercial, but more importantly, social aims. So how do we sort of balance that? Because if we balance the financing end of real estate in a place like Nigeria, we will solve the other problems a lot easier. It will come in at a more affordable price and more attractive.
Thank you, Paul. I don't know, Kafir, if you're here, I have to hand over to Kafir now to take the remaining questions, and there are quite a few good ones. Maybe I'll just link it in because, again, we've gone back to this currency question. Hafiz from HC Capital popped up quite a good question here on, will we ever see a local currency vehicle in sub-Saharan Africa? That might be a good question for Ilaria. I duck off. So I'll just say thanks to everyone. Kafir, if I could hand over the questions to you, and thank you very much.
Perfect. Thank you, Tom.
Cheers.
Thanks, Tom.
Very briefly, I can comment on if you want me to.
Yeah.
On this local currency is very, very problematic because we are talking about currencies that the value on average between 5 and 10% per annum, which is a technical loss if your source of your equity or debt is actually in hard currency. And I don't think it is our role to take that kind of risk because that can actually get you into negative returns. And I'm investing taxpayers' money, and I don't want to give negative returns because of the valuation of currencies which are due to macroeconomic conditions of specific geographies. So it's a very difficult ask, and the hedging possibility is very, very difficult because it's very, very expensive, and therefore someone like you would not be able to afford a loan or which price in local currency risk. Basically, unfortunately, there's a big mismatch. It's a big problem. We are aware of it, but we looked at. We work with some organizations to try to see if there was a way of mismatching currency and hedging. But so far, all the effort have been quite not really getting there. Maybe banks that can raise funds in local, I mean, with deposits could be an effort to lend in local currency at lower interest rates.
Maybe to answer that question slightly differently, I mentioned it earlier. First of all, there is no one single local currency, so the local currency will be a function of the different markets.
Yes.
But you need two components there. You need the rate to be low, which is sort of a function of the macroeconomic, the soundness of the macroeconomic environment, the fiscal policies, and indicators that impact what lending rates to those markets are inflation-related sort of measures. The second bit is also the stability of or the elimination of volatility in those currencies, the movement of those rates. You could have in countries like Nigeria or some of the West African countries, you could have a low rate today. So the relative rates in Nigeria at the moment are somewhat low, relatively low when you compare to historical norms. But the sense is that it's somewhat artificial because it's forced down through external policies. If those policies are sort of eroded or removed, then you might find a situation where those rates then shoot up back up to 18-20% again. So it from a lending perspective, those are the things to sort of find a resolution to. I mean, if you take Kenya, for example, where rates are relatively lower. So, I mean, local currency lending is a little bit more palatable and digestible in that market circumstance. But the view is that the sustainability element of African real estate is somewhat tied to the local currency lending. We have to find a solution that gets to the point where lending is done in local currency, because then the shocks are not external shocks, but you are reacting to internal sort of realities. And I think a starting point to get into that point is actually your equity capital formation sources also has to start to diversify away from sort of the foreign currency sources that exist in the market now, which is predominantly all the sources that exist. If domestic pension funds, in whether it's in Kenya or in Ghana or in Nigeria or Zambia, those become more active in real estate sort of asset creation or funding sort of assets at a domestic level, then that starts to then bring in the debt side of things. The pension funds don't have as aggressive sort of a return requirement as you would find the traditional sort of financial institutions. So those could potentially be a source of sort of debt capital to assets in selected jurisdiction. But I think we're walking the path, but I don't think we're there yet. But that's an active step that could potentially bring some further sort of stability and sustainability to property investments in Africa.
Thank you, Nii. We've covered most of the questions, but I'm going to take 2 questions from the audience, and then we'll start wrapping up with some final thoughts. Nii, maybe just as you were just going on, a couple of questions have been forwarded on to you. So you mentioned earlier in terms of working with your clients, etc. So I think a couple of questions have come in as to what is being done in terms of interest, in terms of capital payments, in terms of reliefs. In those discussions alongside tenants, landlords, how active is your role in terms of those discussions, and what has been done to date, or is it a case-by-case basis?
So as I mentioned, it's a case-by-case basis, but maybe to provide some context to the questions, there is greater flexibility around sort of covenant sort of waivers and covenant deferrals in this sort of situation. Some sort of partial capital relief, but the banking industry or the financial services industry is heavily regulated. So the moment you start talking about interest roll-ups, interest waivers, then you start to talk about undermining the strength of the financial service sector and the operators in there, because then increased sort of non-performing loan provisions just set in. So the reality is you can't apply a one-size-fits-all sort of solution to a crisis like this. You have to look at the realities of it. But I think oftentimes, like other capital providers, the financial services institutions face material pressure from regulators in terms of how they can operate. So that in itself creates a limitation in terms of what can be done or what level of, because you are regulated in a certain way. what sort of forbearance that you can explore or consider. And then it goes back to the point I made earlier around what was the resilience buffer position of the entity of the asset or the counterparty pre-COVID, because both parties have to support each other to survive. It's not of benefit for the developer to survive and the banks that have failed, or the financial institutions fail. So there has to be a sort of a meeting in the middle type solution, which means some forbearance from the financial institution side, some contribution to the solution from the developer side.
Perfect. Thank you, Neil. So just to wrap up with the last question before we just go to some final thoughts, Tom, this one's for you. How has COVID-19 affected current deals on the table? And are you pushing ahead at different or the same valuations as you were discussing pre-COVID-19?
I mean, we're not really talking about valuations. We've had our valuations done a couple of weeks ago, so that's for our portfolio, for our net asset value. There were a few interesting conversations around that, and I think it becomes quite difficult to look into the future, to have a crystal ball. I think at the end of the day, you've got to deal with what the situation at hand. Risk has pushed out, and you could argue the case for keeping your discount rates at very high levels, etc. But that for us, there's physical bricks and mortar. You don't know how you're going to come out the other end. These valuation models are very sensitive to longer term income flows and longer term terminal values, etc. So we've been hesitant to fiddle with that too much. But having said that, we've always been very conservative, as I mentioned previously, both in terms of where we acquire the assets and where we hold them. So we certainly aren't in one of these funds that likes to acquire assets and then push the value up and up and up and stretch the envelope. So for us, we were quite comfortable where we bought them and where we were holding them. So the valuation aspect of it for us was not a major deal. With regard to the question on tenants, there are still, as I mentioned earlier, there are still a number of office tenants that are progressing. Certainly the paperwork, etc., becomes quite difficult to go and view the premises and do measures and do more of the technical type stuff. But there are still a number of office tenants that are looking at it. There are a few retail tenants that have been delayed and that have kind of paused and are taking a view on how this all unfolds. So at this point in time, and again, it's early days, and we don't know where this is going to lead, but at this stage I would say there's a number of tenants that have paused in terms of taking up space, but nobody yet that has walked away and is no longer interested. And there are a few actually that are still opening in the middle of this because they've committed to it in the stocks there, and they can trade at the moment. So mixed, but all in all I would say a little bit of a pause on tenant activity.
Okay, great. So that brings us to the end. So I was thinking perhaps if we could just have some final thoughts from the panelists, just maybe regarding your views on how FDI is going to be impacted and your businesses in the short to midterm, and just some final thoughts. Ilaria, maybe we'll start off with yourself. Your audio.
Done it again. Apologies. Okay. I think it's very difficult to draw a conclusion right now. I think that we haven't yet seen the impact that this situation is having on people's lives and businesses and investments. I don't see this all of a sudden and miraculously ending in 3 months' time or 4 months' time. What is more likely to happen is a gradual lifting of measures coupled with an increasing, hopefully, healthcare capacity, and therefore, and a new, if you like, a new way of living. So I think that in terms of specific for real estate, again, we need more time to assess the real impact. I can tell you, let's take a assumption that all the values will go down by 25% or 35%. On what basis? I don't know. Okay. I think we have to be real what we look at asset, etc. There are some thoughts coming, as in obviously, as we mentioned earlier that in the future there will be more value in what you call low human density assets, logistics, storage, data center, etc., and difficult for high density assets, obviously malls, student housing, hotels. So I think that we have to wait and see a bit what the Fed would be more in general. What we keep doing ourselves is, again, supporting our companies to the extent possible, but also keep on developing our existing relationship and pipeline, because we will come out of this and we want to be there, hit the ground running. And so it's not a question of stopping everything and thinking about it again on the other side of the tunnel. So I think active engagement is probably what you need to do, what you need to pursue, and be flexible, very flexible. Tom was talking about tenants before, said that you have to be. It's not a question. There's no such thing as a blanket that covers it all. So maintain flexibility, maintain engagement, and you'll work it out, and we will work it out.
Thank you. Thanks. Nee, from your end?
I think, I mean, when you are considering investment decisions, and when I say that, I mean both equity and debt capital, there are myriads of considerations that you have. I think COVID-19 has introduced another sort of consideration that you have to have when you're investing. I mean, my sense is that COVID is going to be one of, other pandemics that will happen. You hope it won't, but there probably will be other sort of situations that could potentially have this sort of global impact. And therefore the sector, or the sector, but more the countries and the regions should evolve a way of responding. I watched a news report that talked about the most practical way to handle a global pandemic is in a coordinated manner. We are coordinating responses to isolation, to flight restrictions, to travel restrictions, even to the distribution of a vaccine, if and when it's developed. If there's no sort of global coordination or global network that coordinates that, either at a continental level or at a global level, then you will have the impact or the pace of recovery slowed down by just lack of political infrastructure, for lack of a better word, for people to collaborate. And I think that's something that we all have to start thinking more about, both as nations or as a region, ensuring that there is a network that can be deployed to address these sort of biological or human impact situations. I think that's what we're thinking about, and how to then sort of build resilience across whatever sort of sector of the markets that we operate in. But things will certainly not be the same for a bit.
Thank you. Tom, final thoughts?
Yeah, I think it's very early days in terms of understanding how this is going to unfold and how severe it's going to be. I mean, we all know it's an extremely difficult situation and a very deep crisis. Very hard to plan for the future. I think we just need to be flexible at this point in time and need to be dynamic. And as I mentioned previously, for me, the biggest thing is that we need to understand that there isn't one single entity that is going to come to the whole value chain's rescue here. It's not going to be, a government that saves us, or the banks, or the landlords, or the tenants in our situation. I think everybody's going to have to pick up their portion of the financial strain and work together and communicate, to keep the lines of communication open. I think that's the only way we're going to get through this.
Thank you. And Paul?
Thank you. So I suppose I can speak specifically about Landmark. And yes, I agree with everybody. It's an evolving situation, so we don't know where it will get to. And someone once said, there's no such thing as bad weather, only inappropriate clothing. So there's a strategy for every time. So I mean, I believe, and just to put into context, at Landmark, we had on average 10,000 visitors a day. Today, there are 100. Each of those visitors, the average spend was $7 per head. Today, the average spend on 100 visitors is $2 per head. So it just shows the magnitude of difference and how we need to sustain the business. So it calls for drastic measures. It's not going to be done by sort of looking around and thinking for help. So we've got several points. I mean, one obviously is to suppress our operational costs to the point at which we're literally on life-saving costs. The second is to engage with all our clients and to make sure that by the time they come back, they can pay, and those that can pay, we pay. Those that can't pay, we figure out how to smooth them across the line. To discuss with the funders and ensure that A, they're more patient, and B, sort of expectations are addressed, and see what sort of help we can get. Discuss with the government. I mean, obviously, there are tax issues in terms of tax waivers, the employment subsidy, just to safeguard some of the employment. Discuss with people like CDC that have sort of impact investment criteria to see people, investors who could put together funds on an impact basis. And then at the same time, look at our own social obligations to the community and say, what can we do within this community to strengthen it during these very difficult times? Because whilst we think our times are bad, I mean, around the corner, there are a lot of people in a much worse condition. So just being a practitioner in this environment, as I said, we have 3,000 people working here. 2,900 of them right now are at home. So there are only 100 here. The 100 who are here, half of them on half pay. So it's quite a drastic situation, and I can imagine this replicates itself in several businesses across the country, certainly across the city, definitely across the country, and I'm sure in most parts of Africa. And unfortunately, African governments are not as social as one would like at this point in time, and that could be for several reasons. So we just hope we can all come together as a community, and although this thing won't just go away, but at least ride it until it passes, and then figure out what the long term holds.
Okay, great. Well, thank you. And that brings us to the end of this week's webinar. Thank you very much to our panel, to Ilaria, Nee, Paul, Tom, as well as also Tom Mundy, who moderated. It was a great panel, so thank you for your insights. I also like to thank our sponsors who make this possible, being Nedbank and Standard Bank. We look forward to the next. We'll be running a series that will continue all the way down to June. So next week we'll be running one focused on the development, construction, and project management side of things. So focus on that, and we'll be running that next week. So once again, thank you to our audience, thank you to our panelists, and we're going to sign off here. Thank you.
Thank you.
Thank you.
Thanks a lot.
Thank you. Bye.